Hi, and welcome to Invisor's first video market update. I'm Josh Misk, Vice President of Investments here at Invisor. This is an update that we're going to be doing on a monthly basis just to provide you our insights on the markets. We also do a blog on a monthly basis as well, so if you prefer to read this instead, you can go check that out online. So let's get started and we'll look at October 2015. Global equities, we saw a lot of money drive out in Q3. It's actually the most that left emerging markets since 2008, 2009. I think largely on the fear of reduced growth expectations and increasing corporate debt levels. So what we saw as a reaction in October was central banks either announcing that they were going to continue with their current quantitative easing programs or trying to pump more money into the system, like China, for example. And what they did is pumping more liquidity into the equity markets to make sure that they're going to put a floor on, or to try and put a floor on the drop in equities. Looking over to the U.S., if we look at the S&P 500 as an indicator, the S&P 500 was down 7% in Q3. I think largely on fears that what was going on in China in particular and in oil prices would be contagious to the U.S. market. But we saw that hit a floor at the end of the quarter and rise up 8.3% in October. I think as investors reassess their views of solid market fundamentals in the U.S., those fundamentals, if we look at them, unemployment claims are at their lowest level since 1973, when there were 77 million jobs in the U.S. economy. Today there's 142 million jobs in the U.S. economy. So really there have never been more people working in the U.S. than there are today, which is a positive thing for consumer spending. U.S. housing sales were up year over year. Corporate earnings, although they're down from their recent highs, are coming in above analyst expectations. If we look at the trends in growth and GDP and in real interest rates, those are also up on their 2-year averages as well. So all in all, really positive fundamental data out of the U.S., and we think that's a positive thing going forward. Now, the Federal Reserve met in October, decided not to increase rates, which is, I think, based on fears that the market was still a little bit too tepid based on what was going on in Q3 and maybe not able to handle a raise in rates. But they did indicate that we should see something coming down the pipeline soon, which we think is a good thing. A raise in rates indicates that the U.S. is healed from what we experienced in 2008, 2009, and that we're driving forward with it. Basically, the reason why you increase rates is to curb things like inflation when the economy is starting to grow faster than what you want it to. So it's a positive thing that they would increase rates anytime coming soon. Looking over to Canada now, equity markets in Canada underperform global equities in general. It's due large in part to weakness in the Canadian dollar and weakness in global commodities, particularly oil, which is such a large part of the Canadian stock market. We did have an election in October, did little to shake equity markets or bond markets, but it still remains to be seen if this new government is going to look to pump liquidity in like those global markets are right now as well. So we'll have to keep an eye on that. All in all, in global markets, and especially Canada, we look to the U.S. as the plow horse that's going to get us through this weakness that we've seen as of late. We have all these global economies that are really trying to pump more liquidity into their markets to reduce that weakness, but the U.S. is starting to turn that corner and starting to tighten their policy as growth is really starting to take effect in the U.S. So we don't expect to see excessive growth in the coming months, but we don't expect to see excessive weakness either. There's one other thing I wanted to leave you with this update. If we look at the weakness in Q3, this past month is a prime example of what we mean when we say to stick the course. Looking back at the poor returns over August and September, if you would have sold out of your investments, you would have missed all of the upside that we benefited from in Ontario. It's a symptom that we see time and time again, and this is just a perfect example that demonstrates it very, very clearly. Really, it's not about timing the markets, it's about time in the markets. Most of your goals are long-term. Stick the course, stick to your goal, and you get through the volatility that we saw, just like we saw it last quarter. So if you have any questions or comments on this update, please feel free to email me at josh.misk@invisor.ca. Thanks so much for watching, and we'll see you next time.